I'd like to bring in DoubleLine Deputy CIO Jeffrey Sherman. And Jeffrey, it's been a great multi-decade bond rally. Is it finally over?
Well, it sure looks like it, Charles. We bottomed in rates in the U.S. back in 2020, and it hasn't been a one-way direction upward in yields since then. But if you go back to where we were at the lows roughly in August of 2020, we're about 2% higher, 200 basis points higher than we were back then. And if you do that on a calendar, it's about 18 months. And so given that there was really no yield out there at that time when the 10-year was about 55 basis points, essentially this repricing, the price depreciation has overwhelmed anything that you can generate on the income side. So it's been the worst quarter ever for the Barclays aggregate, or the Bloomberg aggregate is called now. And as you mentioned as well, if the year were to end right now, it would be hands down the worst year that we've ever seen in the bond market to date for investment grade bonds.
So in the meantime, the Fed is taking on the posture that it's never taken on before. I doubt that they will begin. Well, we know they're going to begin like a lion with this whole new regime. But whether they turn into lambs is the big question. I mean, can they, in your mind, do you think Powell and company have the fortitude to pull almost a Paul Volcker from what we're hearing?
Well, I don't think it's going to be Volcker-esque, but there are parallels to this in that they're going to have to raise rates quickly, and they're going to have to do it very meaningfully. And so our estimates right now is that the Fed will hike 50 basis points at the next meeting in May. And I also believe that they will do the same thing in June as well. But really what the bond market has gotten rattled on in the last couple of days is the balance sheet. Right. And this is they've amassed almost $9 trillion of bonds on the balance sheet. And they're very adamant about unwinding the balance sheet as well. So if adding bonds to the balance sheet and cutting rates, those are both accommodative posturing, right? It has to be a tightening posturing on both sides. This is what we're going to call double barrel tightening coming from the Fed. They're not just hiking rates, but they're also going to unwind the balance sheet and let these bonds leak into the marketplace. And so what we got from the Fed minutes yesterday, and you got a little preview from Brainerd the day before, was that this is going to be a significantly faster unwind from the first time they hike, and it's going to be 6 weeks after they first hiked, which was back in March. But what they're also going to do is the caps that they're going to institute on the roll-offs are going to be almost 2x what they were the last time. And so we take some caution about that, because if you think about how long it took the Fed to get to the caps last time when they did this, it was over 5 quarters. And so now they're talking about getting to those caps in 3 months, and it's twice the size of what they did before. Wow. And so we're a little cautious about this, or very cautious about this, because the last time that the Fed got to about $40 billion of bonds a month getting unwound, there started to become some cracks in the system with liquidity, with the plumbing, with shortage of dollars. And so the fact that they believe that they can do 2x that in a very short period of time causes us a bit of concern with the bond market. And I think that's part of what you're seeing in rates today.
Yeah, and I think that's what a lot of folks, myself included, we got to see it to believe it. We know they'll start out strong, but how quickly they fizzle. Hey, I want to ask you, I've only got a minute to go, but I do want to ask you, I had a great interview with Jeff Gundlach back in January 2021, and that's back when he was calling for this great commodities rally. And it's been phenomenal. In fact, the CRB index up 50% since then. A lot of individual commodities significantly higher. Some of that more recently has been influenced by the Russian invasion of Ukraine. So have we gotten near a top, or does this keep going?
Unfortunately, I don't think it's a top. We did take some chips off the table on our commodity positions and just rebalanced back to our target weights back after the invasion, about a week after, just seeing some of that skyrocketing going on in the price levels. But what you find in the commodity market is that there's been just such an underinvestment in capital expenditures for almost a decade now. It's not just the energy complex, but it's also in the industrial metals complex, things like copper, nickel, zinc, aluminum, and they also have high energy input costs. So unfortunately, Charles, I wish I was here to say that the pain is behind us, but at this stage, unfortunately, it just looks like the cure for high prices is higher prices for a longer period of time.
Right. Hey, real quick, let me get this into the producers. We're close, but I got to talk to you about this, because DoubleLine announced this ETF. It's a platform, also your first exchange-traded funds. So what's the focus going to be here?
Well, we've launched one equity product and one fixed income product. And so we're not new to the ETF space, as we've sub-advised many ETFs over the years. But we want to be in control of our own destiny and be able to offer our services out there to clients that prefer the ETF vehicle. So we just launched them last week. They just started trading this week. And we're looking forward to really bringing these products to the marketplace. And so these are some of our flagship strategies that we offer in mutual fund wrappers today. And we think that there's a big demand from the client base out there to access our products through ETFs as well.
Yeah, I think it's long overdue, brilliant, and you're absolutely right. Huge demand. Jeffrey, thank you so much. Appreciate it.
Thanks, Charles. Thanks for having me.